seems that there are major consequences of leaving asset management models unchanged. Is it fair to say, Eric, that investors have suffered from a lost decade in asset management because the institutions have actually failed to update and revive their models?
I think maybe the model was not prepared to see a crash of the US market of 57% during the peak of 2008 to 2009, and then we had all those portfolios actually of our clients suffering some huge loss. Also, they were not prepared for this because they were on balanced strategy, or even for them some conservative. So I mean, that was clearly a big issue that was not identified for the portfolio managers. Having said that, I wouldn't say that we have actually this lost decade, because if we look at the assets of our clients and the assets of our industries, I mean, some long-term investors they were able to recoup this. Of course, the assumption may not have been good, you know. Having said that, at the end, markets have recouped. So, I mean, what is important there is just to make sure that here again, you don't change suddenly your strategy, okay? If you need to adjust the model, you would adjust it progressively, and that's exactly what we are doing. More and more, we are looking at other sources of alpha, we are looking at factors which are actually impacting our portfolios, and we're not looking only at the correlation we used to look at and the matrix of the covariance. This is exactly the modern portfolio theory assumption.
If we were sticking to equity bonds, then variance would be still optimal. I strongly think the world has evolved, and we have much other asset classes which needs to be introduced, which actually lays to the asymmetric distribution of portfolios. That's why we need new concept. I'm a strong believer. So nowadays opportunities makes it much more challenging to model all these aspects we have mentioned. We need to manage the expectation of our client. It's most painful if they give up their strategy, as you have mentioned it. That is like fatal. We need to manage their expectation. We need to explain them what they expect and what they need to prepare for in their portfolios.
Allocation and diversification, two remarks. One is there are times in the cycle where you need to be concentrated, not diversified. When a single factor hits the portfolio, just like during the Euro debt crisis, concentration is probably more powerful than the classic diversification. Second is, I do believe that factor allocation is much more effective than asset allocation. It's part of the problem we've got today. The classic approach in the last 30 years was basically to say that asset classes are driven by macro financial variables, and those macro financial variables can be predicted. And we spent a reasonable amount of resources, time and money trying to predict macro variables. I think it's the different approach is basically to say that risk factors are driven and polarized by macro financial variables for which asset classes can be seen as proxies or hedges. And this paved the way for a different kind of approach, and therefore different kind of organization of the investment space.
I think the important element is, okay, diversification, but around the table, I think that there are two camps. There are people that thinks that the strategic asset allocation as we used to work with it still work, and we have people that thinks that we need to do the things differently. I think that's probably something that we need to explore now, because it means a different way to managing the money. We can still hold our nerves, as you say it, meaning that we stick to our gun and the bond versus equity will continue to work, or we go and explore some form of proxies of bonds, because we know that the bonds have been totally disrupted by the regulation and central bank action and so on. So we need to find some form of proxy for the diversification factor that the bond used to work. Should we go in alternatives? Should we go in non-liquid assets? That's the debate. But I think that's probably the hedge that each investor has to decide. Do you stick to your gun with the strategic asset allocation, or do you want to explore new ways to compose a strategic asset allocation?
But the greatest thing for me is really to rethink the business models. And in particular, I think in the light of what I'm hearing, we need to really think about actions in 3 areas. One is really client proximity. You know, I cannot invest for anybody unless I really know what their risk tolerances are and what their circumstances are. So client proximity is very important. And I think in this regard, I have to say, we can give very high marks to asset management as well as the wealth management industry because, they do quite a lot now to get close to clients. We, for example, do quite a lot of client perception studies for major institutions and so on. So client proximity is very important. Second is really investment capabilities. Do we have investment capabilities to be able to tell the difference between value traps and value investing? I look at actions from central banks every day. I look at statements every day. If I have to make judgments about investing, I really need to understand quite a lot about the psychology of central bankers. Do I have investment capabilities which really get me inside the minds of key decision makers who have the potential to move the markets in really big ways? So that's my second thing. And the third, and probably just as important, is really alignment of interest. If we invest for clients, are we willing to have symmetric rewards? Are we willing to eat our own cooking? Because alignment of interest fundamentally means that asymmetric rewards are out and we need symmetric rewards. But also I think we need to think about non-financial alignment of interest in terms of are we selling the products which client needs rather than the products that we have. But to me the key thing is that at best in today's world modern portfolio theory is a tool which enables you to ask the questions. It does not provide the answers. And I think if we really think it provides the answer, we're really eluding ourselves because it doesn't.